Welcome to Capital Allocation Lab. This is the place where long-term, fundamentals-minded investors come to really sharpen their judgment in their process. We're not here to chase the next hot tip or, the next headline that's flashing across your screen.
And I'm here as your guide through this material. Our operating philosophy here is, well, it's simple, but it's so often ignored. We treat stocks and bonds as what they are, proportional pieces of real businesses. They have assets, they have cash flows, they are not ephemeral lottery tickets. Our goal is to consistently revisit the classic, the enduring ideas of investment, the ones that have worked for decades, and to explain precisely how they remain relevant and in fact are more necessary than ever in today's, complex and extremely fast-moving markets.
And if that disciplined long-term approach resonates with you, if you're searching for clarity and rigor and a repeatable process rather than just market gossip, we'd really encourage you to take a second and subscribe and tap like. It genuinely helps more serious investors find this content, and it allows us to keep building out this free library of foundational lessons. If you find this helpful, subscribe and like to support more educational episodes.
So today we're launching a new foundational series. It's one centered on what many consider the single most important book in all of financial literature. That book is Security Analysis by Benjamin Graham and David Dodd. We'll be referencing the current 7th edition, which provides some crucial modern context and commentary for those original timeless ideas developed nearly a century ago.
Right. And this first deep dive is going to be strictly focused on the intellectual contract we make with ourselves, which is outlined right in the prefaces and the introduction to that edition. We're covering the big ideas behind value investing, explaining why the philosophy endures, and how this bedrock approach can guide you through, virtually every speculative storm the market throws at you, from the sudden rise of a meme stock craze to the next major crypto boom and, the inevitable bust that follows.
Exactly. Think of this as an orientation session, the philosophical grounding. Before we dive into the mechanics, the formulas, the balance sheets, the detailed case studies we'll explore in later deep dives, we have to get absolutely clear on the underlying philosophy. Because without this robust philosophical foundation, the best valuation formulas and screens are ultimately useless. Human emotion will inevitably cause you to abandon them at the worst possible time.
And as we walk through this material, we'd really encourage you to constantly connect these ideas back to your own life. I mean, how might these principles like demanding a margin of safety apply not only to your stock portfolio, but maybe to how you evaluate a career change, or how you manage your team, or even how you allocate your most valuable resource, your time? The discipline is profoundly transferable.
All right. Let's unpack the enduring nature of this fundamental philosophy.
So the first question that any thoughtful listener has to ask, especially someone focused on fundamentals, is this: why? Why are we dedicating all this time in the 2020s to dissecting principles from a book that was first published in 1934? I mean, the financial landscape has completely morphed. We have zero commission apps, instantaneous global execution, complex algorithms, DeFi, high-frequency trading is dominating everything. And why hasn't this wisdom just expired?
That is the essential, unavoidable question, and it's one that the contemporary editors of Security Analysis have to address directly in their preface. And the answer really lies in realizing what Graham and Dodd were not writing about. They weren't writing about ticker symbols or interest rate movements or specific trading technologies. All of that stuff is temporary, it's transient detail. They were writing about the fixed, unchanging human elements of investment and business ownership.
So the technology we use to place a trade, that changes every 5 years. But the core job description for a successful long-term investor and the psychology they have to conquer, that hasn't changed at all, has it?
Not at all. Exactly. They focused on these enduring questions. How do you properly think like an owner of a business rather than just a punter betting on a stock price? How do you develop the intellectual capacity to fundamentally separate the price, that volatile external number, from the underlying internal value of the assets and earning power? And most critically, how do you structure your decisions so that you protect yourself from the only danger that truly matters in investing, the permanent loss of capital?
That distinction, the focus on preventing permanent loss, is so critical because modern technology, while it's made trading incredibly accessible and fast, it hasn't done anything to make analyzing businesses simpler. And it certainly hasn't inoculated investors against that, deeply rooted human temptation toward herd behavior and speculation.
Absolutely not. And the 7th edition preface addresses this continuity explicitly by pointing to modern crises. They note that the 2008 global financial crisis, a crisis built on these complex financial instruments, proved that the core tenets of value investing provided the only reliable defense against disaster. And what's more, the modern economy's shift from tangible industrial assets to intangible assets like software, data, and IP has changed the objects of analysis, but not the method of analysis.
Right. You still have to analyze revenue sustainability, competitive moats, capital intensity. It doesn't matter if the business owns factories or if it owns code.
Precisely. Markets, products, companies, entire asset classes, they evolve radically over decades. But the core logic of value investing is permanent. And that logic, remember, is simply buying an asset for demonstrably less than it is intrinsically worth, and always, always including a non-negotiable margin of safety in the price you pay. That principle is immune to technological shifts, regulatory changes, even global pandemics.
And this leads to one of the most, I think, sobering and simultaneously liberating ideas in the book, and it's right there in the preface. The real secret to successful investing is that there is no secret. Everything important that you need to know about the mathematics and the principles of successful long-term investing has been publicly available for decades. The principles are not proprietary.
Which leads directly to the core difficulty, like you said. If the secret is public, why is achieving consistent superior performance so hard? It's not a knowledge problem, it's a discipline problem. The hard part is not finding the formula. The hard part is actually possessing the psychological fortitude required to follow these principles when markets are loud, when emotions are running high, or when investing based on intrinsic value seems painfully, often embarrassingly, out of fashion compared to whatever hot story the crowd is chasing this week.
So the intellectual principles are straightforward, but their sustained implementation is really a test of character and emotional resilience.
That is the crux of it. And if you're taking the time to listen to a deep dive like this one, you likely already possess some of the necessary disposition. You're the type of learner who's willing to slow down, to do the rigorous work, reading the dense filings, performing original analysis, and perhaps most challenging of all, you're willing to tolerate being fundamentally out of step with the crowd for potentially long periods, even when that crowd seems to be getting rich faster than you are.
So the principles provide the intellectual comfort that we're studying the right material, but the implementation guarantees a degree of psychological discomfort. It asks us to accept periods of looking wrong or, well, looking foolish to those who are only focused on the short-term scoreboard.
That tension, that gap between simple logic and difficult long-term implementation, is the perfect bridge into defining the philosophy itself. We need to sketch out the entire philosophy in plain language, connecting those three key pillars before we start drilling into the specific techniques.
Okay, let's unpack this. If we distill value investing down to its simplest essence, the ultimate goal is defensive, right? We're aiming to buy $1 of demonstrable underlying business value for, say, 50 or 60 cents. But as you always stress, this has to be executed only when you, the investor, fully understand both the operational workings of the business and the associated downside risk.
That iconic dollar for 50 cents image is really the centerpiece of the Graham and Dodd world, and it's been adopted by every successful practitioner since. It's powerful because it encapsulates the three intrinsically linked concepts that form this entire philosophy: intrinsic value, price, and the margin of safety.
To master value investing, you have to master the dynamic relationship between those three pillars. So let's start with the most abstract and maybe the most crucial one: intrinsic value. What exactly does security analysis mean by that term, and how do we even begin to calculate it?
Intrinsic value is the analyst's estimate of what a business is truly worth. It's based on the cash it can reliably generate for its owners over a prolonged, usually infinite period. It's an internal, calculated measure. And it is emphatically not what the stock is trading at today, nor what the chart dynamics might suggest. It's the hard, defensible economic reality of what the business can earn and distribute.
So if I buy 1% of a company, the intrinsic value is essentially the present value of the stream of cash flows that 1% ownership is going to deliver to me over years and decades. And that's true, regardless of what the stock market ticker says tomorrow.
Exactly. And the book notes that determining this value requires a dual-pronged analysis. For Graham, valuation wasn't some single magical formula. He often emphasized two methods. One was earning power, which is the discounted stream of expected future profits and cash flows. It requires extensive forecasting and sensitivity analysis. It's the precursor to modern discounted cash flow models.
Okay, and what was the second method?
The second was asset value, which often focused on the liquidation or net current asset value, what the business would be worth if it were immediately wound down and the assets sold, less the liabilities. Graham stressed that for a defensive investor, the final estimate of intrinsic value should ideally possess a substantial basis in both earning power and tangible assets. That blend provides resilience.
So to arrive at that estimate, the analyst has to look at the entire system of the business, not just the top-line numbers.
Precisely. You have to analyze the fundamentals. The sustainability and quality of revenues, the detailed cost structure and margins, the capital intensity required just to keep the business competitive, its enduring competitive position within its industry, its moat. You also need the strength and flexibility of its balance sheet and, critically, management's history of capital allocation decisions. The market quote is a simple number, but the business underneath is a complex organism you have to rigorously model.
So that's intrinsic value, the internal, calculated bedrock truth of the business. Now, let's contrast that with the market price. The number flashing at you on your screen, changing every few seconds, often with bewildering speed and, well, a lack of apparent rationale.
And this is where the security analysis preface and introduction are famously blunt and, I think, essential. Day to day, minute to minute, share prices often reflect very little about the underlying business reality. They reflect the mood, the psychology, and the urgent needs of other market participants. Raw fear, blind greed, forced redemptions from funds under pressure, sudden inflows of new money chasing momentum, and just passing financial fashion. The price can, and often does, diverge wildly from the business's actual economic reality for long stretches of time.
Which brings us to probably the single most famous metaphor in financial history, the analogy that illustrates this divergence perfectly, that over short periods the market behaves like a voting machine, but over longer stretches it behaves more like a weighing machine.
This distinction is the investor's core guiding principle. The voting machine reflects sentiment. Which stock is popular today? What story is trending across social media? Which sector is the current darling? This is where emotion and fleeting opinion reign supreme. But Graham and Dodd argue, and history consistently confirms, that over the long term, over years and decades, fundamental cash flows, retained earnings, and asset value are the only reliable determinants of final investment returns. The weighing machine reflects the fundamental economic weight of the business.
So value investing is essentially a long-term, patient bet that the weighing machine ultimately, inevitably, wins out over the fickle voting machine. The strategic goal is to purchase your ownership stake when the short-term votes are overwhelmingly negative, maybe even bordering on panic or despair. But the underlying weight of the business is demonstrably solid, stable, and growing.
That is the core belief system. But, simply identifying a solid business at a fair price is not enough, because regardless of your rigor, you could still be wrong. And this is why the third pillar, margin of safety, moves from being just a concept to being a non-negotiable imperative.
Right. Margin of safety. It's often described as the essential buffer, the required discount that protects the investor against the possibility of being wrong. It sounds like simple common sense, but what specifically is the book stressing this margin is supposed to protect us from?
It's protecting us from the unexpected, from the unknowable, and crucially, from ourselves. Every investment analysis involves estimation, forecasting, projecting the future, and therefore, every analysis contains inherent error. This margin shields you from overly optimistic assumptions baked into your cash flow models, against an unexpected severe economic downturn, against simple bad luck, or even against poor strategic decisions made by management after you've invested. It is the practical admission that the future is profoundly uncertain.
Let's use that classic $100 value example to make it concrete. So if I determine a business is conservatively worth $100 a share, the sophisticated value investor doesn't buy at $98 just to get a small discount. Because if you only buy at a small discount, you're essentially betting your analysis is perfect, which is a highly speculative bet in itself.
Absolutely. The value investor's instinct is deeply defensive. They ask, what kind of substantial discount do I need so that if my earning assumptions prove to be 20% too optimistic, or if a major competitor emerges unexpectedly, I still haven't bought something that results in a permanent loss of capital? Maybe you only buy below $70. Maybe, if the business has significant operational risks, you demand $50. The exact numerical threshold, that 30 or 50% discount, requires mature judgment tailored to the specific business's stability and the clarity of its cash flows.
Okay, I want to insert a challenge here based on what we see in the market today. If we are demanding such a steep discount, say a 30 or 40% margin of safety, aren't we automatically guaranteeing we will miss out on the greatest growth stories of the past 2 decades? I mean, companies that often trade at a premium to intrinsic value, or whose value relies heavily on execution far into the distant future.
That is a critical point that forces us to be precise. Value investing is not about buying every stock in the world. It is about finding a specific type of opportunity where mispricing exists. By definition, if a company is universally loved, is the focus of intense media coverage, and it's priced for flawless execution for the next 20 years, the margin of safety is likely zero or even negative. Value investing accepts that we will miss out on those lottery ticket returns. Instead, we focus exclusively on opportunities where the probability of success is high and the penalty for being wrong is low. It is a philosophy obsessed with avoiding risk, not maximizing upside.
That level of defensive rigor. I think that's why the preface pushes back so hard on the idea that value investing is just a mechanical screening process, based on cheap-looking ratios, low price to book, or low PE.
The book provides a powerful warning. Value investing is never merely a mechanical screen that a computer can run. It is a comprehensive, difficult philosophy that demands several non-mechanical traits from the practitioner, things like deep, original fundamental analysis, a willingness to commit to a multi-year time horizon, intense resistance to crowd psychology, and an unwavering, almost pathological obsession with limiting downside risk first and foremost.
That is a fundamental distinction, especially in a modern context where you can download an app, punch in filters for cheap PE ratios, and mistakenly believe you've instantly mastered value investing.
Indeed. I mean, if successful value investing were that simple, there would be no mispricings left to exploit, and certainly no sustained opportunity left for the disciplined learner. The opportunity persists precisely because thorough, original, independent analysis, coupled with the patience required to wait for the right price, are humanly difficult and often painful to maintain over time.
Let's talk more about that difficulty and pain, specifically relating to fluctuating share prices. The preface describes price volatility not just as a financial metric, but as the single greatest psychological challenge in investing, which, paradoxically, is also the primary source of your best opportunities.
It is the ultimate test of conviction. Let's revisit that scenario that tests every fundamental investor. You've performed exhaustive homework, you've read the filings, you've modeled the trends, and you've concluded the shares are significantly undervalued at $100. So you initiate a position.
And then, the market, operating as that voting machine, promptly punishes you. The stock drops 15 or 20%, maybe more, and it just drifts lower over several uncomfortable months. The news flow is negative, your portfolio shows a loss, and the market is screaming that your analysis was fundamentally wrong.
That is the moment of truth. The book emphasizes that in the short term, the market, driven by those voting machine emotions, can make an entirely correct fundamental analysis utterly foolish. You can be 100% right on the intrinsic value of the fundamentals and still endure a significant temporary loss of mark-to-market capital.
Which highlights the vital psychological lesson. The market does not exist to validate your good work on a quarterly basis, not at all. It subjects you to the equivalent of an intellectual stress test, often for months or years, just to see if you genuinely believe your own independent work and analysis, or if you're just following the prevailing sentiment.
And this is precisely where temperament and the margin of safety earn their keep. If you lack deep conviction born from rigorous, independent analysis, and if you haven't built in that margin of safety, it is almost inevitable that you will panic and bail out at exactly the wrong moment, just before the weighing machine finally begins to assert itself. Security analysis provides the necessary psychological framework for interpreting temporary markdowns and avoiding that behavioral pitfall.
Right. It introduces the concept of learning to love markdowns. I mean, if your homework is genuinely solid and if nothing fundamental has materially changed in the business's long-term competitive position or earning power, a lower price isn't an insult to your intellect. It is, in fact, the market offering you a better, more attractive deal on the exact same asset.
A temporary market markdown allows you to do two highly advantageous things. First, you can add more capital at an even better price, which mathematically improves your long-term return prospects. And second, you can simply sit still, knowing that your downside exposure has actually decreased while your potential upside has expanded, assuming the intrinsic value of the underlying business remains perfectly intact.
We have to be absolutely clear on the caveat here, though. The book stresses that value investing is not a passive thing. It is absolutely not buy and hope harder. When the price drops significantly, you have a solemn duty to immediately recheck your original analysis. You have to ask critically, what might the market be seeing that I missed? And you must verify that the price drop isn't signaling a real permanent deterioration in the business.
It is an active, iterative process. You analyze deeply, you buy with a generous margin of safety, you monitor constantly for fundamental changes, and you have to be willing to adjust or even reverse your position if the fundamental facts surrounding the business materially change. The investment is sound only as long as the underlying business facts remain sound.
And this brings us back to temperament. The preface is clear that the traits required for a successful value investor, patience, iron discipline, and emotional resilience, are inherently rare traits in the general human population, which is why the successful application of the philosophy is so rare.
They are deeply counterintuitive traits. Most people, even highly intelligent people, are not wired to sit through long periods of relative underperformance while watching their peers make fortunes in the latest fad. They're not wired to hold views that are radically out of sync with the dominant headlines or the opinions of their social group.
And that psychological pressure is severely amplified when you're managing external capital, isn't it? The preface specifically notes that having patient, long-term oriented capital is vital for the value approach to work. If your clients or your board demand a winning result every single quarter, value investing becomes functionally impossible because the time horizon needed for intrinsic value to be reflected in price often extends far beyond standard reporting periods.
The authors also spend time addressing cognitive biases, the internal traps we all face. This includes confirmation bias, where we only seek out evidence that proves our thesis correct, overconfidence in our own abilities, and the inherent human tendency to ignore contradictory facts if they're painful. The book's prescription is that you must develop strong convictions through rigorous research, but then hold those convictions with intellectual humility and lightness.
That means performing the hard, ego-crushing work up front, truly understanding your thesis inside and out, but then staying intellectually open to new data and remaining willing to change your mind without any emotional attachment or ego interference when the facts demand it.
This relentless focus on temperament drives the importance of process. A robust process is what protects you from your own emotional reactions and cognitive biases. A good process focuses relentlessly on what you, the investor, can control. Things like the depth and rigor of your analysis, the prices you are willing to pay, how you size your positions, and crucially, how you define and measure risk.
And speaking of risk, the preface spends a lot of necessary pages challenging the dominant modern academic idea that risk equals volatility.
This is a radical foundational concept that often separates the value investor from the academic theorist. In much of modern finance theory, risk is statistically defined as the tendency of a security's price to fluctuate a lot, especially relative to the broader market. This sensitivity is quantitatively captured in metrics like beta.
Right, so a stock with a high beta, one that moves around violently, is considered high risk by modern academic theory.
Precisely. But to a Graham and Dodd value investor, that definition is often backward. Volatility or price movement is not inherently a risk. It can be your greatest friend if that movement occasionally serves up deeply discounted prices on quality, fundamentally stable assets.
So in the book's framework, then, risk is defined solely as the probability of permanent loss of capital or the failure to earn a reasonable inflation-adjusted return over a long time horizon. Volatility is just the noise, the necessary psychological turbulence you have to endure on the path to realizing the underlying value.
That links the entire philosophy back to the margin of safety. If you buy a financially sound business for much less than it's intrinsically worth, your downside is structurally limited by the assets and earning power. If the price falls further while the value remains intact, your downside risk shrinks even further and your potential upside grows dramatically.
It creates a beneficial inversion. The more a bargain becomes a true bargain, assuming the intrinsic value hasn't deteriorated, the less risky that investment fundamentally becomes, provided you have patient capital and the correct temperament to ignore the short-term noise and avoid panicking into a sale.
And we should also briefly touch again on the critique of the efficient market hypothesis, or EMH. I mean, if the market were perfectly efficient, all prices would always be perfectly rational, and the voting machine would never exist.
Graham and Dodd's core argument, supported by a century of market history, is that the theory is assuming perfectly rational investors, perfect information, frictionless markets. They're flawed approximations at best.
And those imperfections, those mispricings, are exactly what justifies and makes fundamental security analysis worthwhile. The real world is messy. It's driven by human emotion, institutional constraints, performance chasing, and incentives. Investors herd, they panic, they become widely overconfident, All this human and structural friction creates the mispricings that the disciplined analyst can and should systematically exploit.
Let's shift gears to another absolutely vital theme emphasized in the prefaces, drawing a clear and unwavering distinction between investment and speculation. Given the massive shift into assets like NFTs and meme stocks, this distinction is arguably more vital today than at any point in history.
I agree because the terminology today is hopelessly conflated. We often hear things called investments that would immediately fail the fundamental test laid out in the introduction.
The book's basic test for an activity to qualify as a true investment is very straightforward, isn't it? It's, are you buying based on a careful, rigorous, quantitative analysis of underlying intrinsic value? And are you establishing a substantial margin of safety explicitly designed to protect your principal capital?
That is the defining line. If you are, you're engaging in investment. However, if you are primarily buying an asset simply because its price has been rising, or if your entire expectation of return rests on hoping to sell it to someone else, the greater fool, at a higher price later, without any defensible reference to underlying assets or cash flows, then you are engaging in speculation.
The preface wisely mentions the entire roster of assets that have been called investments in recent years, despite failing this crucial test. Art, collectibles, NFTs, various crypto assets, and the phenomenon of meme stocks, where the price dynamic is driven entirely by retail coordination and excitement.
And the fundamental principle remains the only guiding light. If an asset generates no cash flows whatsoever, zero earnings, zero dividends, zero income, zero productive utility, and its entire value rests solely and exclusively on what a future buyer will pay for it based on psychological momentum, you are squarely in the territory of speculation. Money can certainly be made, but you must acknowledge you are playing a fundamentally different, momentum-driven game, not value investing.
In analytical terms, if a business has zero foreseeable cash flows, the denominator of any discount rate becomes irrelevant because the numerator, the future cash flow, is zero. So you're left analyzing only price action and sentiment, which is the definition of speculation.
That's the technical rigor that must be applied. The speculative impulse is driven by potent psychological forces, the fear of missing out, or FOMO, and the powerful human instinct to herd together. These forces push prices far beyond any reasonable calculation of intrinsic value. Graham's philosophy is an intentional effort to inoculate you, the investor, against these emotional contagions.
One of the more sobering points the book makes is about how modern media and social platforms amplify this speculative distortion. 24-hour financial coverage, endless online forums, and short social media clips create the profoundly false illusion that investing is supposed to be thrilling, fast-paced, and constantly rewarding, delivering instant gratification.
That illusion is so dangerous because it runs counter to the required process. Graham and Dodd's perspective is that real investing, done correctly and methodically, looks more like watching paint dry or grass grow. It requires quiet contemplation, deep reading of filings, methodical and deliberate analysis, and crucially long periods of simply waiting for the right opportunity to materialize. It's careful, it's patient, and yeah, it's often boring.
And the introduction connects this modern speculative impulse directly to historical manias that stretch back centuries. I mean, whether it was the Dutch tulip mania, the South Sea bubble, the 1990s dot-com frenzy, or the recent meme stock rallies, the underlying human pattern is always the same. Narratives and stories outrun economic reality. Prices completely detached from any verifiable intrinsic value, and eventually the gravitational pull of fundamental value always reappears.
And that brings us back to the market shock absorbers, the unforeseen events that inevitably derail the best-laid plans. The prefaces spend time on past crises wars, massive inflation spikes, global pandemics, rapid market crashes. They serve as a crucial reminder that the future will always throw up macro events that we did not and could not model into our spreadsheets.
And that ultimately is exactly why you demand a substantial margin of safety baked into your portfolio. It's not because you can successfully guess the timing of the next war or the next virus. It's because you humbly admit you cannot forecast these events, and thus you protect yourself in advance against the inevitable uncertainty.
The introduction reinforces this final point about risk management. Some risks are calculable and quantifiable, like the probabilistic effect of a specific interest rate move on a known cash flow stream. But others are pure, radical uncertainty, unforeseen, high-impact events you simply cannot forecast or quantify. The margin of safety is the only rational, preemptive response to the vast, unknowable future.
Let's pull these foundational ideas down to earth for the listener with a detailed, practical example of how this defensive process works in reality. So suppose I am analyzing a boring, established consumer staples company, something like a stable utility or a brand-name food producer. I do my exhaustive homework and estimate that under conservative assumptions, the business is intrinsically worth $100 per share.
And that estimate is not a pinpoint number. Because of the inherent uncertainty in forecasting, you have to acknowledge a conservative value range, say that the value is somewhere reliably between $90 and $110 per share. You use that range to establish your safety margin.
Right. So instead of saying it's worth 100, I'll buy at 95, which is highly risky, I decide that I'm only interested in initiating a position if the stock falls substantially below $70 per share, a 30% discount to my conservative value estimate. This means that if the stock is currently trading at $90, I spend the majority of my time not doing anything. I am waiting, exhibiting profound patience, perhaps for months or even years.
Exactly. This waiting period is critical. When the price finally drops into your buy zone, perhaps because of a broad, panicked market sell-off that punishes all stocks, or maybe a temporary, non-permanent operational or regulatory issue at the company, you are psychologically and financially prepared. You know exactly what the business is worth, and you know the defensive price you were willing to pay for it. You act decisively when others are fearful.
Okay, so let's imagine the price drops to 65. You buy. What happens next, and how does this process guide your exit?
You then employ reverse logic. You focus on discipline at the sale. If and when the price eventually rises back toward or even exceeds your conservative estimate of value, say it runs up to 115, you begin trimming or exiting the position. This discipline must be maintained even if the stock continues to run higher afterwards, defying your exit decision.
The discipline around both buying and selling is a massive emphasis in the preface. Price matters intensely at both ends.
Absolutely. Leaving a little money on the table, that last 5 or 10% of a run-up, is completely acceptable and preferable to risking round-tripping the entire gain by refusing to sell when the price becomes wildly overvalued relative to the business's fundamentals. You can't allow yourself to become a speculator just because you fear missing out on the last bit of gain. Owning a great business is insufficient if you pay a fantasy price for it.
So, to synthesize and recap the 5 foundational threads that emerge from these opening philosophical sections of security analysis for the dedicated learner.
First, value investing is about treating a stock or bond as a proportional claim on real business cash flows and underlying assets. It's not just a highly volatile trading token based on momentum.
Second, intrinsic value and market price are fundamentally distinct animals, especially in the short run where sentiment dominates. Volatility can be your friend if you're prepared, disciplined, and rigorous enough in your analysis to exploit it when it serves up bargains.
Third, a substantial margin of safety is the single most non-negotiable principle. It is the practical tool that accounts for mistakes in your analysis, poor management decisions, the possibility of bad luck, and all the inherent unknowable factors of the future.
Fourth, temperament and a consistent process matter just as much as, if not more than, intelligence or analytical skill. Patience, iron discipline, constant self-critique, and an unwavering analytical framework are your ultimate, enduring edge against the emotional market.
And fifth, the clear line between investment and speculation depends entirely on your method and your expectations, not on the specific asset class you're using. Are you rigorously analyzing value and protecting capital, or are you just hoping someone else will pay more later?
And finally, the conclusion that ties the whole philosophy together.
Sure.
The world will always change. New technologies, new financial instruments, new crises will appear constantly. But the core logic of buying demonstrable value with a substantial margin of safety is one of the most remarkably stable, enduring, and ultimately successful principles known to finance.
As we move deeper into security analysis in future deep dives, we will begin applying these foundational ideas to specific cases. We'll explore the calculation of ratios and dive into balance sheet structures. These prefaces and introductions served as the essential map and compass, defining where we are going and, more importantly, why we are focusing on these core ideas.
And before we wrap up, let's just circle back to the purpose of Capital Allocation Lab. Our mission is pure: to teach disciplined, long-term investing by revisiting classic ideas like these and translating them into tangible decisions you can use today to improve your own process.
No forecasts, no promises of easy riches, no trading signals, just clear, detailed explanations, simple examples, and a relentless focus on sharpening your long-term judgment and refining your repeatable process.
If you'd like us to zoom in on a particular concept from security analysis in a future deep dive, perhaps solely on the rigorous calculation of the margin of safety, or a deep dive into the value framework as applied to high-growth growth businesses that lack tangible assets, or specific Q&A episodes on balance sheet analysis, let us know what interests you most.
You're also welcome to share questions about your own specific investing process or challenges. We may anonymize them and address some of the most common or insightful ones in future Q&A episodes, as we continue to build this resource for the fundamentals-minded investor.
Thanks for joining us today inside Capital Allocation Lab.
If you found this useful, like the episode and subscribe. It really helps us keep these foundational lessons free and accessible to more long-term, fundamentals-minded investors.
Stay patient, stay curious, and remember, focus relentlessly on what the business is intrinsically worth, not just on what the noisy market is shouting at you today.
We'll see you in the next episode.